So I want you to imagine sitting behind the wheel of this state-of-the-art sports car.
Okay, I'm picturing it.
Right. And the engine is just purring perfectly. The oil pressure is flawless. And the speedometer says you were cruising comfortably at, like, top speed.
Sounds like a great ride.
Yeah. Everything on the dashboard is telling you that you're having the drive of your life. But then you glance down at the GPS, and it insists you are currently hurtling backward off a cliff.
Oh, wow. Yeah, that's the ultimate cognitive dissonance right there.
Exactly.
You desperately want to trust the physical instruments right in front of your face, right? But the external signal you're getting is completely detached from the physical reality of the vehicle.
And that exact cognitive dissonance, that total mismatch is happening right now with the $300 billion tech giant. We're talking about Netflix.
Yeah, it's a wild situation.
So for you listening, our mission today on this deep dive is to tear apart a comprehensive market analysis report we got our hands on and essentially solve a massive financial mystery.
It really is a mystery because we are looking at a globally dominant company whose actual business is, by all accounts, firing on all cylinders.
Right.
Yet somehow, it has lost over 40% of its stock value in a single year.
Which is just staggering.
It's a textbook paradox, and honestly a fantastic case study. We are watching this brutal tug of war between a company's fundamental operational reality.
Like the actual cash they're bringing in.
Exactly. The actual cash versus the stock market's emotional sentiment. And if we look past the glaring red arrows on the stock ticker, the underlying data tells a completely different story about where this cultural force is actually heading.
And understanding that disconnect, I mean, it's essentially a masterclass in how to evaluate any business when the broader market is just in a total panic.
Absolutely.
So we really need to start by looking at the sheer violence of this drop, because according to the data, Netflix's stock recently took a breathtaking plunge.
It was ugly.
Yeah, they hit a 52-week low of $65.08. That was on July 17th, 2026. Right. And this is down from a peak of $126.71.
So almost cut in half.
Yeah.
And if a casual observer, only looked at that chart, the immediate assumption would be that the core business model was completely failing.
Oh, 100%. You'd think they were just hemorrhaging subscribers.
Bleeding cash left and right,
Yeah.
or that, I don't know, a rival streaming service had rendered them completely obsolete overnight.
Right. The chart basically screams that the streaming era is dead. But then you turn the page of the report and look at the actual money they are making, and the numbers are just staggeringly good.
You really are.
Like, top-line revenue is growing at 16.02% year over year, which, for a company of this immense size, moving the revenue needle 16% is, it's like trying to accelerate a glacier,
Yeah, it's a massive ship to steer.
But they are pulling it off. But the real shocker for me, honestly, is the profitability.
The margins.
Yeah, they are operating with a gross margin nearing 50%. It's 49.12, and a net margin of 28.22%. Earnings per share is sitting at a highly robust $3.17. I mean, they even beat Wall Street's expectations for their Q2 earnings.
We really need to dissect that net margin figure for a second.
Yeah.
Because it completely defies the historical physics of the entertainment industry.
How so? Like, compared to traditional studios?
Exactly. A 28% net margin in Hollywood is, well, it's almost an anomaly. Traditionally, making television and film is a notoriously low-margin grind.
Because of all the physical overhead, I'm guessing?
Yeah, the physical costs of production. You've got sets, actors, global distribution deals, and the massive marketing campaigns required just to get eyes on the screen.
Right, you have to buy billboards everywhere.
And TV spots, yeah.
Yeah.
That usually eats up almost all the revenue. So for Netflix to pay all those bills and still retain over 28 cents of every single dollar as pure bottom line profit.
While growing at 16%, mind you.
Right. While simultaneously growing their revenue at 16%. It just indicates this absolute fortress of operational efficiency.
So we have a perfectly functioning dashboard, but a GPS screaming about a cliff. If the Q2 numbers were a blowout, what actually triggered the massive sell-off?
Well, that's the kicker.
The only analogy that makes sense to me is like a high school student who aces their final exams, brings home a flawless report card, but then tells their parents, hey, just a heads up, AP Physics is going to be really tough next year, so I might only get a B.
That's a great way to put it.
And the market, playing the role of the hyper-demanding parent, just grounds the kid for the entire summer.
That captures the psychology perfectly, honestly. The trigger wasn't the past performance at all. It was the forward guidance.
The dreaded forward guidance.
Exactly. Management provided an outlook for the rest of 2026 that the report characterizes as, quote, narrowed and cautious. And this is where you really have to understand the mechanics of momentum investing.
Okay, yeah. Break down how those momentum algorithms actually behave in a situation like this.
So in the tech sector, a vast amount of capital is controlled by momentum investors and algorithmic trading models.
Right. The bots.
Yeah, the bots. And they do not buy a stock just because the company makes a lot of money today. They buy based on the acceleration of future growth.
They want it to go faster and faster.
Exactly. They are betting on the second derivative. So the moment that future growth looks like it might decelerate, even slightly, or even just become uncertain, those algorithms are programmed to just exit.
Wow, they don't even ask questions.
They do not stick around to ask nuanced questions about 28% net margins. They hate uncertainty above all else, so they liquidate their positions immediately.
Just a total dump.
That reactionary, automated dumping is the primary force that drove the stock down 25% year to date.
It really feels like punishing a runner for finishing a marathon in record time just because they said they might be a little tired for the next race.
Pretty much.
But there is a flip side to this panic, isn't there? Because of that massive sell-off, the valuation metrics have completely shifted. The report points out that Netflix is now trading at a price-to-earnings, or PE ratio, of 21.38.
And this is the exact counterargument that value investors are scrutinizing right now.
Okay.
The PE ratio is essentially the price tag the market places on $1 of a company's current profits. Historically, dominant tech platforms trade at massive premiums, often 30, 40, or even 50 times their earnings.
Because they're the cool kids on the block.
Exactly. Investors gladly pay that premium because they expect the profits to double or triple in the near future.
So paying 21 times earnings for a mega cap tech platform that is still growing its revenue by 16%, I mean, that seems remarkably cheap.
It's highly reasonable. It suggests a major psychological shift in the market.
How so?
Well, that multiple of 21 means that the slower growth management warned about isn't a secret anymore. It is already physically priced into the current $65 stock value.
Ah, so the penalty has been paid in full.
Exactly. The penalty has been paid.
Which implies that the downside risk is significantly mitigated now compared to when the stock was, flying high at $126. The speculative air has basically been let out of the balloon.
Precisely.
So knowing that the foundation is actually quite stable, we have to look at how Netflix plans to navigate this so-called cautious future.
Right. What's the actual game plan?
Yeah, the report outlines a very specific two-pronged global strategy. They are pivoting toward local language hits and then expanding those into global franchises. And they are leaning heavily into their deeply integrated, data-driven recommendation engine to build this competitive moat.
And that recommendation engine is the critical piece of the puzzle here. It's not just about having a massive library of shows. It's about how the platform routes those specific shows to very specific subsets of users.
I am going to push back on this strategy, though, just a bit.
Okay, let's hear it.
We hear local language hits touted by literally every streaming service as the holy grail. But how does financing an incredibly expensive niche production in, say, South Korea or Germany actually move the financial needle for a global juggernaut like Netflix?
It's a fair question.
Because maintaining physical studios, dealing with local unions, and funding localized production teams all over the planet, that just seems like massive budget bloat. Is the juice really worth the squeeze?
If we look at this through the lens of traditional television economics, your skepticism is completely warranted.
Right. It seems way too expensive.
But Netflix operates on a totally different plane of physics, primarily due to the mechanism of amortization.
Amortization, so spreading the cost of the asset out over time.
Exactly. But in this case, they are spreading the cost across geography, not just time.
Oh, interesting.
Let's imagine a traditional regional television network in Germany. If they greenlight a $50 million local drama, they absolutely must capture a massive percentage of the German viewing audience to pay for that show through local advertising or carriage fees.
That's an incredibly high-risk bet.
It is. But Netflix possesses a truly global subscriber base.
Mhm.
When they spend that same $50 million on a German original, they are not relying solely on the local audience to recoup the investment.
Ah, I see, because the recommendation engine identifies these microgenres across borders.
Precisely. The algorithm
Mm-hmm.
takes that German show, dubs it, subtitles it, and methodically pushes it to fans of that specific genre in Brazil, the United States, Japan.
Wow.
They are taking a localized, fixed cost and extracting global, scalable value from it.
That fundamentally changes the math.
Yeah.
Because they can afford to massively outspend local broadcasters in specific regions, creating incredibly high-quality television while still maintaining those 28% net margins globally.
Exactly.
A regional competitor physically cannot match that production budget because they just don't have the global audience to amortize it against.
And that, right there, is what creates the competitive moat. It builds this invisible wall around their ecosystem. As a consumer, if you become heavily invested in a highly specific, localized Netflix franchise, your switching costs become incredibly high. You can't simply cancel your subscription and move to a rival regional platform because that rival simply cannot afford to produce the scale and quality of the franchise you want to watch.
So the sheer scale funds the localized content, which then feeds the global algorithm, which locks in the subscriber, which in turn funds the scale.
It's a flywheel.
It is. It's an endless, self-sustaining loop. So that covers the slow and steady fundamental engine. But our sources also detail a massive, unconfirmed rumor that honestly changes the entire trajectory of the conversation.
Oh yeah, this is the fun part.
If this rumor is true, it is a complete paradigm shift for how users interact with the platform.
You are referring to the potential Letterboxd acquisition.
Yes, exactly. The report highlights ongoing whispers that Netflix is in serious talks to acquire Letterboxd. And for anyone listening who isn't a cinephile, Letterboxd is effectively a dedicated social network just for movie fans.
It's huge among film buffs.
Yeah, it boasts over 30 million highly engaged users who meticulously log, rate, review, and debate every single piece of media they consume.
So why do you view this specific acquisition as such a pivotal turning point? Because Netflix has experimented with, secondary features before.
Because it fundamentally solves the single worst user experience problem in streaming. The endless scroll.
Oh, the endless scroll. We've all been there.
Right. Right now, interacting with Netflix is largely this solitary, isolated experience. You sit on your couch, you open the app, and you're just confronted with a wall of thousands of choices.
Yeah, it's paralyzing.
You spend 40 minutes paralyzed by indecision, just scrolling through tiles until you eventually give up and watch an old sitcom you've seen 10 times.
Exactly.
The black box algorithm is trying to guess what you want based on your past clicks, but it completely lacks the nuance of human curation.
It knows what you let play in the background while you were folding laundry, but it doesn't know how the content actually made you feel.
Exactly. But if they integrate Letterboxd, they aren't just buying an app, they are buying a 30 million person human curation engine.
That's a great way to frame it.
Just imagine the UI shift. You log into Netflix, and instead of a sterile row of algorithmic guesses, your home screen is populated by your actual friends.
Oh, wow.
It says, hey, your best friend gave this new thriller 5 stars yesterday, or your favorite film critic just wrote a glowing review of this documentary. It shifts the cognitive load of choosing what to watch from the user to their trusted social network.
From an analytical and valuation standpoint, the implications of that shift are profound. Analysts actually refer to this kind of event as a blue sky catalyst.
A blue sky catalyst.
Yeah. Integrating 30 million highly engaged users isn't just a cosmetic upgrade. It is a structural evolution of their moat. Currently, the algorithm relies on passive data, what you click on, how long you watch. Letterboxd provides incredibly rich, intentional data. They would know exactly why you loved a film, what specific elements you praised in your review, and which social connections actually influence your viewing habits.
So how does Wall Street react to a company transitioning from a content provider to essentially a social network?
It acts as an immediate re-rating event. Let's go back to that PE ratio of 21 we talked about.
Right, the cheap valuation.
If institutional investors suddenly realize that Netflix is no longer just a digital pipe delivering television, but has actually become an entrenched, interactive social media ecosystem.
The math changes.
The valuation math completely changes. Social networks command significantly higher premiums because user engagement is just stickier and the data is vastly more valuable.
Right.
It completely erases that whole narrative of cautious growth and replaces it with ecosystem expansion.
That is an incredible upside scenario. But, to maintain a clear-eyed view of this report, we have to contrast that blue sky potential with the current turbulence, because there are bearish headwinds rattling the stock right now, and we need to figure out what is actual structural damage versus what is just temporary noise.
Yeah, that's crucial. The report specifically identifies a few points of friction. First, there is a broader macro rotation occurring, which basically means institutional capital is generally rotating out of the tech sector entirely.
Got it.
But there is also a specific, localized, legal friction. A financial exchange platform called Kalshi is demanding that Netflix take down a trailer for something called prediction games, citing defamation claims.
See, this is where I struggle to weigh the impact, because true crime, investigative documentaries, unscripted drama, that is a massive engine for Netflix's engagement.
Huge.
If a financial firm is hitting them with defamation lawsuits over a single trailer, does that threaten to bog down their entire documentary pipeline and litigation? Could this legal friction actually impair the business model?
This requires us to exercise one of the most important skills in financial analysis, which is distinguishing between a noisy headline and a material impairment of cash flow.
Okay, lay it on me.
Defamation lawsuits are inherently messy. They generate terrible PR, and they force corporate legal teams to burn billable hours. But you have to scale the problem against the size of the entity.
So you're saying we need to look at the math, not the drama.
Precisely. Does a singular lawsuit regarding a trailer fundamentally threaten the free cash flow generation of a $300 billion enterprise with a 28% net margin?
Probably not.
The answer is almost certainly no. The report accurately categorizes this as an isolated noise event. It is a known litigation risk, which is honestly a standard cost of doing business at that massive scale.
Right.
But it does not crack the foundation of their primary business model. The macro rotation, the broader market moving money away from tech stocks, is exerting vastly more downward pressure on the share price than the Kalshi lawsuit ever could.
That makes perfect sense. It's a headache, not a heart attack.
Exactly.
Which brings us to arguably the most revealing data set in this entire document, the insider trading metrics. Because if you want to know if a company is secretly in trouble, you stop listening to the press releases and you watch what the executives are doing with their personal bank accounts.
And the data here presents a really fascinating puzzle. If you only glance at the surface-level summary, it paints a rather grim picture. Over the last 90 days, the net share count for insiders is negative.
Negative.
Yeah, they have unloaded a net total of 946,554 shares.
Wait, if the people steering the ship have sold nearly 1 million more shares than they've bought in just 3 months, the immediate instinct is to assume the ship is sinking, like they're heading for the lifeboats while telling the passengers everything is fine on deck?
That is the trap of looking at raw volume without understanding the distribution. You have to look at the architecture of those trades.
What do you mean?
Well, the report highlights that despite the massive negative net share volume, the insider management sentiment rating is scored at a perfect 100.
Okay, stop right there. A negative net share count of almost 1 million, but perfect positive sentiment.
Yeah.
The math only works if, one single executive sold an absolute mountain of stock for personal reasons, but dozens of other managers are quietly reaching into their own wallets to buy small blocks of shares. Is that what we are looking at?
You've diagnosed it perfectly. The quantity of shares sold was heavily skewed by a few massive liquidations. And this is incredibly common. A founder or top executive might sell a huge block of shares to pay taxes on vested options, buy a house, or simply diversify their personal portfolio.
So it's not a panic sell.
No, it rarely reflects their outlook on the company. But when you look at the frequency of the transactions, the entire narrative flips.
Okay.
Over that same 90-day period, there were 58 separate individual buy transactions initiated by insiders, compared to only 52 sell transactions.
Wow, so that completely changes the context. You have a broad coalition of managers, directors, and executives deliberately choosing to buy the stock at this depressed $70 price point.
The breadth of that buying activity across the management tier signals deep structural confidence. They are analyzing the exact same PE compression we discussed. They see the cash flow, and they are aggressively buying the dip.
That's huge.
And importantly, this confidence isn't isolated to just the insiders. The options market is currently flashing a very similar, albeit slightly more complex, signal.
Right. The report mentions that options traders are currently capturing 9.5% premiums. Can you explain the mechanics of that? How does fear in the market literally translate into cash for these traders?
Sure. It is easiest to understand options premiums by thinking about the insurance industry.
Okay.
When a hurricane is brewing off the coast, the cost to buy flood insurance skyrockets because the perceived risk is massive, right?
Yeah, everyone's panicked.
In the stock market, volatility is the hurricane. Because Netflix's stock has dropped so violently, fear is incredibly high, which means the insurance premiums on the stock are wildly expensive.
And how are traders actually capitalizing on that expensive insurance?
Sophisticated traders are selling what are called put options. By doing this, they are essentially writing an insurance policy.
Got it.
They are entering a legally binding contract agreeing to buy Netflix stock if it drops even further below its current price. In exchange for taking on that perceived risk, the market pays them a cash premium upfront.
And it's at 9.5% right now.
Right now, that premium is a massive 9.5%. They are literally being handed a high cash yield today, simply for promising to buy the stock at an even cheaper valuation tomorrow.
That is a staggering level of conviction. I mean, they are so confident that the floor won't fall out from under the company that they're willing to underwrite the risk just to collect the cash.
Exactly.
So let's pull all these threads together and synthesize the broader picture for the listener. We are looking at a stock that recently bounced off a massive psychological and technical support level of $65, rising 3.68% over the last 5 days.
Yep.
The fundamental engine is churning out revenue at 16% growth with unheard of 28% net margins. The insiders are quietly, consistently buying the dip, and options traders are happily collecting massive premiums to wait it out.
It's a solid setup.
Ultimately, the report assigns Netflix a bullish score of 8 out of 10 as a 3 to 6 month swing trade. It seems the play here is to simply wait for the next earnings report to validate the growth, or wait for the letterboxed acquisition to drop from the sky and completely rewrite the narrative.
It is an incredibly compelling setup based purely on the company's internal merits. However, no stock operates in a vacuum, right?
Right.
And we have to leave the listener with one crucial macroeconomic watch point.
What's that?
The report notes a highly specific metric. Netflix carries a beta of 1.524.
Explain how that beta acts as a multiplier on the stock's movement, for those who might not know.
Sure. Think of beta like a rubber band attaching a specific stock to the broader market index. A beta of exactly 1 means the stock moves in perfect lockstep with the market.
Okay.
But Netflix's beta of 1.524 means it is essentially 50% more volatile. If the broader market goes up by 1%, the rubber band snaps Netflix up by 1.5%. Conversely, if the market drops, Netflix drops significantly harder.
So it basically exaggerates whatever mood the entire market is in.
Exactly. And right now, the entire market is hyper-focused on the Federal Reserve and the trajectory of interest rates.
As always.
As always. If the Fed provides a dovish signal, meaning they hint at cutting interest rates, that typically relieves immense pressure on the entire technology sector. Because Netflix has such a high beta, a broader macroeconomic relief rally could act as a rising tide that lifts this specific ship incredibly fast.
Wow.
The macro environment could trigger the rally before the fundamentals even have a chance to.
So, if you are analyzing this stock, you are watching the Federal Reserve's rate decisions, you are actively monitoring the letterbox rumors, and you are waiting to see if management's cautious 2026 guidance was actually just a brilliant piece of expectation management.
Setting the bar low.
Yeah, setting the bar artificially low so they can vault over it and completely surprise the market later.
Under-promising today to guarantee an over-delivery tomorrow is one of the oldest, most effective corporate strategies in the playbook.
It really is. Now, before we wrap this up, I want to leave you, the listener, with a final thought to mull over, something that builds on everything we've dissected today.
Let's hear it.
We spent a lot of time talking about that potential letterbox acquisition and how it solves the endless scroll. But think about the broader cultural implications. If Netflix actually succeeds in integrating a 30 million person social network directly into its streaming interface, are we witnessing the dawn of a completely new era in digital infrastructure?
A true convergence of utilities.
Exactly. We are looking at a future where streaming platforms don't just host the television and movies we consume, But they completely swallow and replace traditional social media platforms as the primary town square where we discuss our culture.
That's a wild thought.
We might not just watch movies on Netflix anymore. We might actively live our digital social lives within their walled garden. And if they successfully execute that pivot, transforming from a content pipe into a social ecosystem, well, then that GPS on our dashboard wasn't broken at all.
It was just recalculating.
It was just recalculating a completely new route to a destination that the rest of the market hasn't even mapped out yet.
That is a truly fascinating perspective to walk away with. The market's algorithms are looking backward at the cautious guidance, but the company's architectural strategy is looking entirely forward.
The disconnect couldn't be clearer. Thank you for joining us today to unpack the mechanisms behind the headlines. Keep your eyes on those underlying fundamentals, ignore the reactionary noise, and we will catch you on the next deep dive.